Hi, I'm Kuiper with CFRA Research, and in this short video, we are going to look at Bitcoin from an investor's perspective. Particularly, we're going to look at what Bitcoin is, how it compares to gold and other currencies, what role it may play in an investor's portfolio, and one way to think about valuation. Before we begin, for disclosure purposes, I, Kuiper, personally own Bitcoin. This video is for informational purposes only and is not meant as a recommendation to buy or sell Bitcoin or any other cryptocurrency. So what exactly is Bitcoin? If you were to ask 5 different people with knowledge of Bitcoin the seemingly simple question, what is it? You would probably get 5 different answers. We believe Bitcoin is truly something new, so trying to describe something new with existing terms and analogies is difficult. It's similar to how it was hard to describe the internet in its early stages. Also, the word Bitcoin can refer to 2 different but related things. There is Bitcoin, the network, which refers to Bitcoin as a network of computers and a payment system. And then there is Bitcoin, referring to the digital tokens that are increasingly being treated like money. So let's first talk about Bitcoin, the network. Bitcoin as a network is a decentralized, peer-to-peer monetary payment system. At its heart, Bitcoin is just code. It's code that's run on many computers that are all networked together, much like the internet. Also like the internet, the Bitcoin network is decentralized. There is no single authority that controls it. The Bitcoin code controls how the network operates, but the code itself is not owned by anyone. It is an open source protocol. This protocol is similar to how HTTP is a protocol that governs how web pages are used and operated. This Bitcoin network then produces and moves around a native digital token, also called Bitcoin, that are similar to money or currency. All of these pieces work together to make Bitcoin one giant payment network that is capable of sending money from anyone to anyone around the world without the need for a bank. So we've talked about Bitcoin, the network, and a payment system. Now let's talk about the Bitcoin tokens. These are the digital native tokens that exist on the network and are created by the network. These tokens are increasingly being treated as money. So how is Bitcoin, the token, like our current money, like a US dollar, and how is it different? On the similarity side, we can see that you can send Bitcoin, you can receive it, you can buy things with it, or you can convert it to other currencies. Also, Bitcoin fluctuates in price compared to other currencies. You can also trade Bitcoin on an exchange, just like you can trade currencies on a foreign currency exchange. It may seem strange to think of these digital Bitcoin tokens as money and attribute value to them, but note that this has already been happening in many virtualized and digitized parts of our lives. For example, video game players buy digital tokens with US dollars to use in their games. Or credit card points are really digital tokens issued by companies with the ability to spend them, send them, transfer them, or convert them. Fiat currencies such as the US dollar, Japanese yen, or euro are already largely digitized. So in this way, Bitcoin is just like another digital currency. However, the biggest difference between Bitcoin and our fiat currency today, like the US dollar, is that Bitcoin is not owned, controlled, or backed by any government, central bank, other institution, or company. In other words, there's no single person or institution that can control the movement of Bitcoin. Remember, the Bitcoin payment network is a decentralized network, similar to the internet. So just like it would be nearly impossible to shut down the entire internet, it would be nearly impossible to shut down the entire Bitcoin network because the computers running and upholding the Bitcoin code are located all over the world. The other major difference between Bitcoin and our modern fiat currencies is Bitcoin's monetary policy. It has a pre-programmed inflation schedule where there will only ever be a maximum of 21 million Bitcoin in existence. This gives Bitcoin relative scarcity with a money supply that follows a strict rules-based approach rather than central bank actions. So while new Bitcoin are still being minted, Bitcoin's pre-programmed inflation schedule stipulates that the rate of Bitcoin being generated be cut in half approximately every 4 years. Currently, Bitcoin's annual inflation rate is approximately 1.8% per year and is set to decline into the future. So if we think of Bitcoin as an alternative money, it's helpful to compare Bitcoin to the historical money of gold, a commodity money, as well as our modern day fiat currencies. Over time, many things have been used for money, including beads, shells, or stones. But history has shown that good money possesses a number of similar properties. First of all, good money is durable. And by durable, we mean it doesn't rust or rot or decay, but it's also durable in that it maintains its value or purchasing power. Divisible simply means it can be divided into smaller units easily, especially to pay for smaller transactions. Fungible means each unit can be exchanged for one another and they are identical. Portable is how easy it is to transport geographically or send to other areas. Verifiable refers to how easy it is to check that the money is not fraudulent or that it's genuine. History, here we mean its track record of success. How long has this money been around? And then for scarcity, how supply constrained is the money itself? So if we look at Bitcoin along these characteristics, we see it actually fulfills a lot of them, except for history, as Bitcoin has only been around for about 12 years. If we compare it to gold, Bitcoin actually improves upon a lot of gold's deficiencies, mainly its divisibility, its portability, and its verifiability. But here gold beats Bitcoin in terms of its history, as gold has literally been around for millennia. Finally, if we look at modern day fiat currencies, and by this I mean fiat currencies that are not certificates that you can be redeemed, they're not backed by anything, but are current free-floating exchange rate fiat currencies. Here you see the fiat currency falls short on a number of these characteristics. Mostly it is not durable in that it does not maintain purchasing power, and it is not scarce. The only thing limiting fiat currencies is the central bank or government backing or issuing it. There is no physical constraint like there is with gold or Bitcoin. So why Bitcoin as an investment, or what role could Bitcoin play in a portfolio? Remember that the supply of Bitcoin is restrained and Bitcoin is therefore scarce. There will only ever be 21 million Bitcoin in existence. Furthermore, nearly 90% of that total have already been released, and Bitcoin's inflation rate continues to decline. Therefore, some investors may view Bitcoin as a store of value. Also, compared to the current US money supply growth rate, Bitcoin may also increasingly be looked at as an inflation hedge. Here you can see the inflation rate of Bitcoin is currently 1.78% per year. In about 3 years, this will get cut in half to only 0.84%. This is much lower than the US CPI average as well as the global inflation rate average. The other major role Bitcoin could play in a portfolio is as an alternative investment. The two most desirable characteristics of an alternative investment is for these investments to add diversification and an asymmetric risk-return profile. In terms of diversification, Bitcoin has shown so far a very low correlation to other major asset classes. As you may know, in finance we say diversification is about the only free lunch, as it can dampen your volatility and lower your risk without sacrificing potential reward. In terms of asymmetric returns, here we can see that Bitcoin has provided a lot more upside than downside over the past 6 years. Here we're looking at a traditional 60-40 portfolio of 60% stocks and 40% bonds, compared to this traditional portfolio that adds 1% exposure to Bitcoin or 5% exposure to Bitcoin. You can see the traditional 60-40 portfolio has a compound annual growth rate of almost 9%, with a max drawdown of 12%, and is very highly correlated to the US stock market. As you add in Bitcoin, we see the compound annual growth rate go up. While risk also increases, this is more than offset by the increase in returns, as you can see the Sharpe ratio increase. Looking at the traditional plus 5% Bitcoin, we see the compound annual growth rate is more than doubled, as well as the ending balance of the portfolio after 6 years has almost doubled. The standard deviation does go up quite a bit, but the max drawdown only goes up a little bit, and the Sharpe ratio increases greatly. The US stock market correlation also goes down. Of course, past returns are no indication of future returns, but we can see from this perspective of why this might appeal to many investors. The question of how to value Bitcoin is a tricky one, since Bitcoin has no cash flows and pays no dividends. Further, since Bitcoin continues to evolve, the narrative surrounding Bitcoin and its value is also evolving. We therefore think it makes sense to try to value Bitcoin from multiple angles and models. Nevertheless, we present one very simple model here, which is Bitcoin's relative value to gold. As we explored earlier, Bitcoin possesses many of the same characteristics as gold, and is in fact superior to gold in many ways. For example, it's more easily verifiable, divisible, portable, and storable. This has led some to label Bitcoin as gold version 2.0. So if more investors also see Bitcoin as a new and improved version of gold, and also a good store of value, it might be helpful to consider a wide range of potential outcomes of Bitcoin taking a percentage of gold's market cap. With gold trading at $1,850 per ounce, the total amount of investable gold is nearly $12 trillion. This assumes the cumulative amount of gold mined that is above ground. Bitcoin, on the other hand, trading at about $35,000, has a market cap of only $650 billion, so about 5% of gold's market cap. If this were to increase to 7%, this would imply a Bitcoin price of nearly $45,000. If this went to 10%, it would imply a Bitcoin price of nearly $64,000. And if it went to 15%, it would imply a price of $95,000. Now note in this example, this assumes the price of gold remains at $1,850 per ounce, and the total amount of investable gold is nearly 12 trillion. In other words, if the price of gold were to increase, Bitcoin's price could also increase without increasing its percentage of its market cap compared to gold. Again, this is just one simple way to think about the value of Bitcoin. We're going to look at another valuation model for Bitcoin in an upcoming webinar on February 11. We'll also dive into some of the most common questions around Bitcoin, as well as the risks and myths surrounding it. You can register for free at go.cfraresearch.com/Bitcoin-guide. Also, after you register, you'll also have the opportunity to download our free 20-page investor's guide to Bitcoin. Finally, for disclosure purposes, I, Chris Kuiper, personally own Bitcoin. This video is for informational purposes only and is not meant as a recommendation to buy or sell Bitcoin or any other cryptocurrency.